All right, Chris, good evening. How are you?
I'm doing great. Tusif, how are you this evening?
Doing great. Really appreciate you hopping on again.
Love talking with you, Tusif, and love talking about this kind of stuff. So, ready to dig in.
Awesome. For people who are first time in this channel, we are Chris and Joseph, tax professional based out of Virginia, but we are helping people out all across the nation. So if you have any questions or concerns regarding taxes, feel free to reach out and would love to answer all of your questions gradually. But if you have not seen our previous video, we just finished our series seven episodes, and we cover pretty much a good chunk of real estate areas. So make sure to check those out. And today we will be moving on to another interesting topic, that is tax preferred vehicles. Chris, help us understand what pretty much does it mean by tax preferred vehicles in the first place.
Well, Tusif, I think if we're going to put this into what I call everyday people talk, we're going to be telling them what it is. Retirement plans, if I'm not mistaken, right?
Yeah,
Everybody.
Yep.
So, and to start off, guys, if you have a good account now, Tusif and I said, yeah, we're here in Northern Virginia, but also I have clients all across the nation here. I've had clients in Hawaii, California, New York, Florida, Texas, what have you. I have not had any in Nebraska yet. So if you're in Nebraska and need some help with your taxes, please contact us because I'd like to help out with that one. So and also this is going to be just information. You want to sit down with your tax advisor like Tusif or I to actually see what your situation is and how the tax rules apply to it. So that's just the IRS requires us to say, hey, this is not tax advice, this is information. We're talking about retirement vehicles, and everyone, your parents get on you when your first job says, have you signed up for that 401k yet? And of course, it's that I've got that taken care of, because it really, what it does is a couple things right off the bat. Is it's going to lower your W-2 income that you're taxed on and puts the money away so that you'll be able to take it out at a lower tax rate, and allows it to grow tax free until you retire. So, and now, of course, Tusif and I love talking with business owners. So we have the self-employed retirement plans, which I really love, because what's great about them is that we can go in and do your return and come back to you say, well, Mr. Tusif, you owe about $5,000 a year, but if you put this much money, if you put $6,000 in your retirement fund, we're going to drop that down to $3,000. And so you can actually make the contribution by the time you file your tax return for the prior year. So you don't have to rush and get it done by December 31st. And that's why I love these, because it's a great way to lower your taxes. So if you have not done so, right now it is November 29th. If you have not signed up for a self-employed retirement plan with your financial advisor, do so. Tusif knows a lot of great people who can help you with that and make sure that you're set. But what these are, the retirement vehicles allows you to take a deduction for them, and also reduces your taxable income at the same time, setting yourself up with assets that can grow into your retirement and can pay for your second life after you're 59 and a half, or so the limit is right now. We'll see what Congress does in the coming years as people start retiring younger. So that's what we're talking about here. There's a big FIRE movement, financial independent retirement, retire early. So that's why I have to put in a caveat that there could be some people who are retiring at 29. Who knows? I missed that. Maybe Tusif is getting there thinking about retiring soon, but I'm a little older than him.
I definitely am, to be honest. Next 5 years, I'm done. But
well, we'll still do this show, folks. It's fun for us, so we'll keep doing this in retirement.
yeah, I mean, here's the thing. A lot of people think that retirement is not doing anything. To be honest, retirement is not doing anything, but retirement is having the opportunity to do what you want.
Exactly.
As a matter of fact, I feel Chris is retired quite a few years ago, since he said goodbye to his corporate career.
Yes,
it's like, hey, I'm gonna do the way I want to do things.
Yes, indeed.
I feel like there's one of the best things in US economy that encourages taxpayers to do is focus on things that is going to help you retire better. Of course, retirement plan itself is a tax benefit, but investments and businesses are significant benefits of the taxes, which pretty much drives you towards a better life in the retirement in the first place.
Yeah, and Tuz, if I could throw out just a plug for a great website I have, it's called the Millennial Revolution. It's about two kids that focused really hard on saving. She came from China, immigrated over to Canada, and they actually had $1 million before they turned 30. And you can just please check out Millennial Revolution, the website. Tell them we sent you there, and just see how their journey went, how they focused on, they didn't buy a house, but they set aside money in the different investment vehicles, which we'll be talking about over the course of the series, so that they could retire with $1 million. And here's the thing, folks, you think they'd use that up, but nope, their portfolio has actually gone up.
Absolutely.
So, something to think about.
I actually saw that, I think a couple of years back. I actually saw that. That was a really intriguing thing. That's one of the first things that made me think, how can I multiply my money in the first place? Now, Chris, coming back to what you just said, 401k and self-employed retirement plans. Some of the examples. What else do you else are included in these? Do you think like IRAs, Roth are also into these?
Yes, I do. It's going to be that. Now, there's going to be some income limits as to what can be deducted, or even for in terms of a Roth, what can be contributed. I don't have the income levels. $6,000. It's $6,000. There's also, for old guys like me, because we're over the age of 50, we can contribute a little bit more, so we're not living off the government dole, where we hope. So what those can do is, you can, for IRA contributions, if you're under a certain income level, make it down so you can see my pretty face. If you're under a certain income level, that you will be able to deduct the contributions. But with a Roth, you won't be able to deduct it on your taxes, but you will be able to make those contributions after tax, so that when you pull the money out, there's less in retirement, you're not taxed as much, because you've already paid the tax on the money that you've contributed.
So that's a great point you brought up. So what happens if I were to put the value of my shares? So say, for example, someone owns capital stock, and instead of taking the distribution now, what he does is puts interest into Roth. Can someone do that?
Yeah, if you are receiving distributions from your investments, you certainly can invest those. The only limit's going to be how much you can put in during the course of a year. The big problem I have with IRAs and Roths, and I've gotten this from clients before, is that if you make a certain amount of money where you can actually afford to make those contributions, you're making so much money that you're not allowed to make those contributions. So I've had some very choice words said, not to me, but about it, saying, well, why do I even have a Roth if I can't make a contribution? And the thought is, when you're young, you'll start building up equity in this. Or if you have kids, start a Roth for them, so that they can start building some wealth. But yeah, if it doesn't really matter where the money comes from. If you're getting a distribution from it, get a little paycheck, of course, or a little check from them, of course, you can put that into the Roth or the IRA to help it grow. But when I say that, you may want to sit down with your financial advisor to see if the investments you have are providing the best return, instead of shifting money from your investments into the retirement vehicle. You want to have something that's going to really build your retirement. And if you're just shifting things from one to another, yes, I know it's a distribution, maybe your retirement plan isn't all it's cracked up to be.
Awesome. So just to divert here a little bit, is there a difference between Roth and self-directed IRA?
Yes.
Awesome.
There's going to be a difference between them, just really with what is going to be taxable, because the self-directed IRA, you're usually putting in pre-tax dollars, because you're taking a deduction for that. But with a Roth, it's going to be after-tax dollars.
Awesome. And in any of this, I guess there's so many good points. I guess one of the biggest cons that comes to mind is the age limit.
Oh, in terms of when you can contribute, yeah. For the IRA, you do have the age limit. I believe it's 72, if I'm not mistaken, dear Tusif. Or am I getting that mixed up with the
72 is the minimum
R
distribution, RMD,
RMD?
required minimum
Yes.
distribution.
So yeah, so it's just going to be when you have the IRA, but with the Roth, if I'm not mistaken, you can continue to contribute to that. But talk to your financial advisor to see what you can do with the age you are and what is the best strategy for that. Tusif and I are not financial advisors, so you want to make a good relationship. I know some good ones. Tusif knows some great ones as well. So it's I work in conjunction with them to set that up so that asking them what is the best salary, what is the best strategy for that.
Absolutely. And as a matter of fact, if the biggest caveat to these, I feel like, is the age limit. If you take the money out before 59 and a half, you're going to be hit with another 10%.
Yep, and I've seen too many people do it. And you know what, folks? My hands up. I did the same thing when I was a young man, and I actually used it to buy a washer and dryer. We just needed it, but you know what? It was better than commuting. We had to commute 20 miles to use to a
Lawn
laundromat.
laundry?
But that's a story for a different day. But if
Awesome.
you can have keep it in there as long as you can. It's not timing the market, it's time in the market. So don't take those. There are some exceptions to the 59 and a half rule. Buying a house, medical bills, education. There are going to be a couple other ones, but those are going to be the big ones that's going to hit a majority of the people. So just keep that in mind. But if you please keep it in up until 59 and a half. There's a great columnist out here, Tusif and I, where in the Washington Post, Michelle Singletary, always points out if you're going to take retirement money out of to pay for your kids' education, don't, because your kids can always get loans, but there are no loans for you in retirement.
That's a great point. And as a matter of fact, one of the things that so what is that 10-year rule for Roth IRA? Let me ask you this first. Help us explain.
Right. So what happens is that you need to keep, before you take any withdrawals, you need to have that money in there for the 10 years. If I'm not mistaken, we talked about the same rule.
I think so. Yes.
Yeah.
So
if you're going to invest in a Roth, you make sure that you're not going to need that money for some other purpose, because it's got to be in there for a while before you can start making withdrawals.
awesome. So in that case, what happens if I just take after 10 years? Am I going to be still subject to, say, for example, I started Roth at 30 years of age. Am I going to be able to start taking distribution at 40 years without penalty?
Well, what you're allowed to do is you're allowed to take distributions of your contributions that you've put in. You can't touch the interest. So you're able to do that.
Awesome.
But again, I would still say keep that money in there, because it's time in the market. The more you have in for a longer period, the more you're going to have for retirement, unless you want to be working at a job when you're 70 years old.
Absolutely. As a matter of fact, this is one of the unfortunate truths of the current situation. A lot of people forget this specific area, and they end up in a very bad situation. Like when I first came to US, there was a lady working with me at Pizza Hut. That's I think $6 an hour. And she was 69 or 79, any of those years of age. And unfortunately, she couldn't afford to retire. I felt bad for her. And that's when I was also looking into these, like, hey, if you have, especially most of these, the way these retirement plans work is you're allowed to invest into these retirement plans. And what it does is the interest that grows, it also gets tax preferential treatment. And what it ends up having is, say, for example, in 401k or IRAs, all the growth are tax deferred. Yep. But as a matter of fact, in the Roth IRA, since it's post-tax money, if you have 60, 70, 80% growth some years, the entire money is tax-free. Exactly. So just make sure to understand and sit down with your financial advisor as well, And another thing is if someone dies and if you inherit it, it's also going to have significant preferential treatment similarly as well. But of course, the tax, if it is a Roth, you're not going to be paying any tax either as inheritance. But the other ones, there's going to be, depending on how the trust, if there's trust as well, there might be some elements of taxes as well, but there's going to be some level of preferences in the deferment.
Absolutely, and that's the thing. I'm glad you touched on that too. So if you are to inherit Uncle Bob's IRAs or retirement accounts, sit down with your advisor to see, because the estate is going to talk to you. Okay, how do you want to receive these? Do you want the vehicles themselves, or do you want the cash? That's when you go to your financial advisor and your CPA and say, what's going to be best for my situation? Because
Absolutely.
money, cash received from an estate is tax-free. But if you have the IRA, there's going to be other rules that go along with that for how long the 10 years that you have to clear it out.
Yes.
And then or you have to do something with it. And if you're under a certain age, or if they had to start taking RMDs, that may affect you too. So that when you find out that Uncle Bob or Aunt Ethel has died and you're in the will and they ask you, what do you want to do? Get on the phone with your CPA, get on the phone with your financial advisor, say, hey, here's what's happening. What's the best for my situation? And
Absolutely.
they'll be able to direct you what to do with it.
Absolutely. And as a matter of fact, another interesting point on these, especially 401k, which is offered by a lot of employers, is these allow you to take loan against them.
Yes. Yep. And that's it's up until your base. I believe it's a basis, if I'm reading this right.
Basis, and I think up to $50,000 or 50%. I forgot one of the 50s.
Yeah, and exactly. So but also keep in mind that you pull this out, that's less insurance that your beneficiaries will be receiving. But if you need that cash for something, let's say credit cards have gotten too big, you can pay off the credit cards, but you best start putting money back into that insurance policy to get it cut up. And they are going to charge you interest on that. So just please keep that in mind.
Absolutely. And an interesting part of it is sometimes it might be more beneficial because you're going to be actually paying interest onto yourself.
Yep.
To some extent. So essentially, make sure
on a 401k, if you take a 401k loan, yeah, you are paying interest to yourself.
Yes. So essentially what happens and ends up happening is you are leveraging that money, you are getting that liquidity. The difference is your payments might be extended. So make sure if you're someone like, I had a friend who invests in real estate. What he did is he took loan against his 401k, now paying himself back after the refinance amount, which worked out great. Now, let's touch on a little bit on annuity and life insurance. Let's start with annuity. Chris, help us understand that part.
Well, the annuity is kind of be it's almost like a retirement plan, but you've set up, you've paid someone a certain amount of money to get a certain cash flow over a certain period of years. And the taxable portions of that's going to be not the amount that you pay. Say, okay, you put in $10,000 and you're going to get income stream of $1,200 a month or $1,200 a year. So it's going to be over 10 years. So 1,000 of that, or 1/10 of what you put in, is going to be the tax-free return of your investment, and the 200 is what's going to be the earnings.
Absolutely.
That's how that's going to work.
As a matter of fact, there's a very interesting element, as Chris mentioned, is think of it of putting in layman's terms in real estate. You are getting a cash flow in the form of interest, but the difference here is you are getting taxed only on the amount that is above your basis. So what a basis means is that about the one that you put your money in.
Yep.
And you're still getting that cash flow back. So instead of holding that into bank, that might sometimes be more significantly beneficial. And there are some of the annuities that you are taking the distribution far away. And some of them are also tied to the market, which might have significant amount of growth.
Yep.
And just make sure to sit down with annuity structure. I personally am one. I think, Chris, you're also licensed to do that as well.
I do have a insurance license and a life insurance license, so I can talk. It's something that probably what I would do is say, you know what, go talk to Tusif. It's been a little while since I've done any insurance work, so I want to make sure that you are with the right person. So I'd say, you know what, I can help you a little bit with this, but Tusif's going to be your guy to walk you through the insurance stuff.
Absolutely. Let's come to the insurance part then. How is that tax preferential or tax in terms of, say, for example, if someone were to buy, one of the biggest stigma I had before getting into the tax knowledge is, why do I have to buy an insurance if I have to die to get the money?
Well, so you know what, Tusif, did you have that thought before or after you got married?
Before.
Okay, so there we go. Are you thinking about it differently now?
I mean, as a matter of fact, I had it even after for a while, but then I started learning about more into how the entire thing works. Now my thought process has significantly changed.
Right. It's something, like you buy auto insurance and you're like, oh, I'm never going to have an accident. Okay, well, maybe everybody's going to probably run into some kind of fender bender. But even more tragically is that if something were to happen to you, how would your family survive? They got to pay the mortgage. They have to pay for kids, braces, food, clothing, because Lord knows, and Tusif you'll find this out when your kids come. They go through clothes very quickly. But you don't want to leave them in a position to have to scrounge when you're not there.
Mm-hmm.
So that's the benefit of having life insurance, so that they can go on, and because they don't have you anymore to help them. Now premiums, they're not tax deductible anymore. Health insurance premiums, okay, we'll talk about that in a little bit. But for life insurance, the big thing, sometimes you don't do something for the tax effect, but for the effect it has on your life. Because Absolutely. If you're sitting there in a situation and you're in an accident or something, and it's serious, the last thing you want to be thinking about, or what you're going to be thinking about, is what's going to happen to my family. So buying this provides you a little bit of mind, so you can calm down and maybe survive this traumatic experience, because you're not as tense, that worried about your family.
Absolutely. And as a matter of fact, that's some of the great benefits. But one of the more benefit in terms of an investor or a business owner is the cash value of it.
Yep.
And there's two main elements of it, I guess, types of it. One is whole life, another one is IULs, index in universal life.
Yep.
And these are the primarily used because one of the biggest things is not only that you're paying premiums, it's actually growing in their cash value itself. And what it means is cash value is something that you can take the cash out.
Yep.
And also you can take the loan out. So essentially, if you have a life insurance policy at the age of, say, for example, 50, and you take loan, you have a value of that, say, for example, $1 million in policy, in cash value. You had it for 20 years, and it's also closing maturity. You can actually take that $1 million loan against your own self and go buy properties or go buy other businesses as if it was there.
Yep.
And still be paying back yourself, your own policy. And on top of it, your monthly premiums are not increasing unless there's some other elements that the way it's structured. But in most cases, if it's structured properly, monthly payments are not increasing. You are using your own cash. You are actually getting benefits of the life insurance itself. But remember, if you do take the loan, and God forbid you die in the middle, the amount your family is going to receive is the difference.
Exactly.
But
so it needs to be part of a whole strategy that when you're doing this.
And as a big thing, the growth inside a life insurance policy, the death benefit is tax-free.
Yep.
So if someone dies with life insurance, that the benefit that the family is going to get is pretty much tax-free.
Exactly.
And interestingly enough, if you start having this way, what you're essentially doing is you're taking after a certain amount of time, you're actually not using this as just an insurance policy, but using this as a bank. Or take loan against yourself, and you're paying yourself interest. And in most cases, most of the companies give you dividends. So the interest that you charged and the dividends you get at the end of the year, in most cases, you get a positive amount on top of the money that you're already having, even though you don't have that money into that policy.
Amazing how that works.
Absolutely. That's one of the ways Rockefeller families have been dominating the entire US economy. I was literally amazed at a very interesting book, The Rockefeller Way. I think, is it The Rockefeller Way or the What Would the Rockefellers Do? I think one of the twos.
Yeah.
They talk about this strategy significantly well, and I feel like they have cracked the codes on this one.
Right. And it's like there's another classic, I'm sure, too, if you've read it, Rich Dad, Poor Dad. And the great line from there is poor people buy liabilities, rich people buy assets. So when we're talking about loans here and taking those against, we're not sitting here advocating to go buy a Lamborghini. Don't. What we're saying is, as Tusif said, go out and buy properties that is going to increase your wealth.
Absolutely.
So when we're giving advice, like I said a couple shows back, that when business owners come and talk to me about, well, can I take a deduction for this? No, don't spend something don't spend like for a marketing program or what have you, unless it's going to bring in more dollars. So Absolutely. If you're thinking about going to spend something, how much more dollars is going to bring in?
Absolutely. And that's a great thing that Chris mentioned is liability versus assets. One of the best definitions that, to be honest, my financial journey started myself educating in a big way through that book. So I definitely recommend that book. And the best definition of asset versus liability is assets is something that puts money in your pocket. Liability is what takes it away.
Exactly.
So make sure to think what it does. That's why even in marketing, if it is not bringing money in your business, it's a liability.
Exactly. So, don't try and do something just because everyone else does it. It's going to put money in your pocket for your family. That's all you should be concerned about.
Absolutely. So the last element that we're going to be talking about today is, of course, more of the health insurances. I know it's not the most best system, but at least if you are in a bad situation, there's some level of tax and stuff. Help us understand that part, Chris.
Well, so Tusif, we're going to have a couple things. One, you may get insurance a couple ways. One, you get it through your employer, which is also should be reducing the amount of your taxable income from your paycheck. Another way is that you're going to be self-employed, and you're going to be able to take a deduction for self-employed self-employed health insurance. We talked so long about retirement, it's on my mind now. So you'll be able to take a deduction for that. And there are some caveats among that. I mean, among that is that you actually have to have income in order to be able to deduct it, because you can't take things from nothing. I believe the word is you can't get blood from a stone. Well, you can't get health insurance premium deductions from something that's not earning money for you.
Yep.
And then another way is it might be through Social Security, have withheld. And if there are any seniors watching this, and if you're having Social Security, please take withholdings on Social Security, because I've had too many seniors who've gotten in trouble because they didn't have that was the money that they were getting and they didn't have taxes. So you have people on Social Security having to pay the IRS for the withholdings that were never done.
Yeah.
But it also can be an itemized deduction, and we can talk more about that a little later for the medical, that if it's you're able to take a deduction if it's more than 7.5% of your income. So those are the ways that the health insurance premiums are going to help you. And in addition, if you're a business owner, if you're paying for health insurance premiums for your people, for your employees, that is a deduction as well. And you got other things like medical reimbursement plans, 125 cafeteria plans, what have you, that we'll get into at some future point. But these are going to be deductions that you can do.
Awesome. And I know it sounds bad. very interesting and bad at the same time is you have to have at least 7.5% or more expenses to even get the deduction. So I have to be sick enough that I have a lot of expense, but after that I can at least spend or get some tax deductions. But
Yeah, most of the
another
people that
interest,
happen to it, they're over 80 years old is the only time I've been able to say that, or they've had something catastrophic. So yeah, I disagree with that system, and but President Biden hasn't sat me down to have a beer and talk about this.
we definitely have to schedule a tea or coffee with President Biden sometime. But another
Yeah.
interesting thing in this health sector is an HSA.
Yes.
Is depending on how much there is, you can actually max out HSA and still get a deduction.
Yep.
It is a deductible tax amount, but the only caveat to that is you can only use that money for health related issues.
Exactly. Yes. Please make sure that, and that's a question we always ask when we see that you had distribution from HSA. Did you use these for medical things? Because you can't, again, take a deduction from or take a withdrawal from an HSA and go buy a Lamborghini. Although I want to know where you can get a Lamborghini for what you have in your HSA, but that's another conversation. So yeah, you got to make sure that's done. Otherwise, the amount becomes taxable.
Yep. So if you are someone like even a sporty guy having to have some level of injuries and you have to buy braces, you have to buy some. Let me ask you this, Chris. Do you know if the supplements for better fitness is going to be tax deductible or qualifying, or it has to be something that prevents a disease?
Well, it really the definition that I've seen and worked with is if a doctor has prescribed it for you, it's deductible.
Yes.
Anything over the counter now, okay, so a little bit if it's over the counter, not deductible. However, with some HSAs, if you pull it out and buy the stuff that's over the counter, that's medical. So you're going to be okay with that.
Awesome. So definitely look into this, especially the people who are into sports. I personally had this issue that I ended up in a sports injury and had to spend quite a bit of money. But at that time, I didn't have the HSA, so had to pay them out of my pocket. So definitely, sometimes these are some of the good things to have in your life as well. All right.
Indeed.
Awesome. Appreciate your time. So we are going to be keeping these episodes now even short and simple. And as a matter of fact, one thing I wanted to touch base is I know in the previous episode we spoke about the vehicle deduction and the depreciation. Of course, we spoke about two methods. One is actual expense. Another one is mileages. So the mileages does include depreciation on top of it. So what I meant by that is if you are keeping the actual receipts, actual expenses, a lot of people forget that there's also depreciation involved in it. And IRS, in some cases, does allow to switch between them. So make sure to sit down and have a conversation. But depending on what type of car you have and stuff like those, because there's something that's also called 179 deduction, which does allow you to take the bonus depreciation up front into big cars like SUV, which are more than 6,000 pounds.
Yep.
Awesome. Anything else I missed out on this one?
No, Joseph, it was a lot of great questions and a lot of great topics that people, I'm sure, got a lot of value out of. So, folks, let us know in the comments if there's things you want us to talk about, because we're always looking for new material. Not that we're comedians, but it's what I say to my clients is, look, if you ask me a question, I know the answer to it. I can tell you, you feel good, you tell people how wonderful we are, and it's everybody benefits. But if we don't know, we can look it up and get smarter and then come back to you and tell you what you can do. I said to people before, the tax guide that I have is about maybe 3 inches thick with very thin paper in there. There's a whole bunch of stuff that I don't know yet, but it's there where we can look it up and find. And
Absolutely.
yeah, no question is ever going to be considered. Stupid is getting a notice from the IRS.
Absolutely. Awesome. Just to summarize what we spoke about today is we touched a few very interesting points, especially if you're a business owner or even W-2, is retirement plans, which if you're a W-2 owner, definitely may be thinking about maxing those out, because for pure W-2, unless you're one of the other episodes strategies like real estate professional with your spouse or short-term rental, there's not a whole lot of elements that we could do. Another thing is, if you're self-employed business owner, definitely look into it. If you are even if you're at the end of the year, even if the year ends, you can still contribute to that and take those deductions, but make sure to plan for the money that you're not going to be touching up until 59 and a half.
Exactly.
And the second thing is, we spoke about annuities, which is pretty much a upgraded version where you're putting money in. The only thing is this post-tax money, but the difference is the money that you're putting in, when you're taking it out, it's tax-free pretty much. And the third very important thing was infinite banking, which was using life insurance, where we spoke about leveraging, taking money from yourself, paying yourself it back as if the growth itself was based on the entire money that was there in the first place. And the last but not least, we spoke about some of the deductions that you can take as a self-employed or W-2 owner with health insurances and HSAs. Anything else I missed out, Chris?
Nope, you're very comprehensive, Tusif, and the amount of time that we had to talk about it. So thank you for the great questions and observations.
Thank you very much. With that, I will see everyone in the next step. Thank you, Chris, for hopping on today, sharing us your knowledge again. And if you have any questions for myself and Chris, feel free to do so. We would, as Chris mentioned, we would love to answer those for you guys. With that, thank you very much again, and we will see you